So just want to thank everyone for coming tonight, and because we've got a relatively small group, I'm happy for it to be interactive as well. So if people feel comfortable at any time they want to ask a question about what we're going to go through, please just unmute and jump in and ask the question. But yeah, what we're going to cover today is, and I know it's a few weeks after the budget's been announced, but there's been some developments or legislative changes or whatever else it might be that have come through since the budget was announced. So we're just going to go through the budget and what that means from a small business point of view, and then also talk about some business planning tips for the rest of this year, and also how to bounce back and what to look out for in 2021. So yeah, interactive would be great. So if you've got any questions along the way, because some of it might be really relevant to you and you want to ask a bit more, and I prefer to cover it at the time as opposed to then wait to the end and then you might have forgotten what you wanted to ask. So yeah, please jump in. So I'll get started, and I've always got to start with my general advice disclaimer. So this is general advice only. It's not relevant, it may not be relevant to your particular circumstances. So please don't act on any of this advice based on what I present tonight. If you need further information or you want to take further action based on what we discussed tonight, then you need to seek advice either from us as your accountant or from someone else who may be relevant to your circumstances. So always have to do that just to cover ourselves and comply with the regulations. But first part, let's get into the budget. And what we're going to do is we're just going to cover a few key items, but just a quick overview. So it's a $98 billion support package, including $25 billion under the COVID-19 response package and $74 billion under the JobMaker plan. And I'll go into the JobMaker plan shortly. Key thing with this is that the deficit for the next financial year is expected to be $213 billion, which is an amazing number, much higher than what we've ever seen before, and it represents 11% of the gross domestic product of Australia for the year. So that is a huge number, and when you look at that in the context of what our economy is on a year-by-year basis. So our economy roughly runs around the $2 trillion mark per year, and they're going to spend pretty much 11% of our domestic product in the next 12 months on the current year's budget. And then they predict that the debt will peak at $966 billion, which again is an amazing number for a country like Australia, where we haven't talked on those sort of numbers in the past, very close to $1 trillion. But from my point of view, the comforting thing about that is it's only 44% of GDP. So when you look at Australia compared to other developed nations, even at that figure of 44% of GDP, we're much better than most countries in the Western world. So it means that, yes, we've got a large debt, and yes, how do we repay it, or do we ever repay it? But secondly, it means we've got a bit of room to move because our debt is nowhere near what it is in other countries. I think we're half of what the UK is. The US is running around 100% of GDP, and I think other countries are even higher than that. So it's a big number, but it's not dramatic, or it's not nothing to be, I think, not to be overly concerned with, particularly with the cost of finance at the moment being relatively cheap. The unemployment rate is expected to peak at 8% in next month, and then expected to fall by June. So in the next 18 months, expected to fall down to 6.5%. I'm going to make a Shane McKenna prediction here, which will be probably completely wrong, but I reckon we'll be bounced back quicker than that. I think we'll hit 6.5% earlier than that, based on what I'm seeing with my clients, and also what the government stimulus is doing, and how we're starting to bounce back out of the COVID-19 situation. But really, the focus on the budget is to put us back into growth, because we're in negative growth at the moment. We're first recession in 29 years, and then to try and build consumer and business confidence. Obviously, the economy is dependent on people spending money, both businesses and individuals. And that's what the government is saying this budget is directed towards. So just to give you a visual on that, a picture, a snapshot of that in terms of what it means. So there's accelerated personal tax cuts. There's extended instant asset write-off for depreciable assets. That's really important. There's a new provision called the small business loss carryback, which I'll go into a little bit of detail. Also, they're talking about R&D incentive, additional $2 billion in R&D. Further expansion of small business concessions, and I'll cover that shortly. Some changes regarding super, which are only minor, to do with employers and effectively, trying to cut down on the administration costs within super. There's a lot of money being spent on transport, including the Melbourne to Tullamarine Airport link. JobMaker, which is one of their new slogans and new offerings, the government. So we've got job keeper, we've got job seeker, we've got job maker, in the same vein of those, and I'll go into that in some detail. And then also looking to try and encourage businesses to employ another 100,000 apprenticeships through a wage subsidy of up to 50%. So just a visual on what the different things are. And then I've decided, or Chelsea and I've picked the top 5 that we thought are the most relevant to people. So the first one is bringing forward tax cuts. So originally there was tax cuts that were proposed to happen from 1 July 2020, and then further cuts happening from 1 July 2024, and the government has brought those forward. Now, I've said here, subject to passage of legislation, it actually has passed now, so I should have updated that, but it has actually passed and is law. And if you're receiving a wage, you'll start to see in your, probably this current pay packet you'll see the increase or the reduction in tax withheld, and therefore the increase in take-home pay. And what they've proposed is these different changes to the thresholds. And I'm not going to go into these just here. I'll click it on the next page, which gives a better visual of what's happened. So this is what happened pre-budget. This is what the situation was. Then we've got in the next column what was backdated to 1 July 2020, which is as per the budget. And then what's also still proposed from the 1st of July 2024. And you can see no change in the first column, being the 0% tax rate. In the 19% tax bracket, they've increased the threshold from 37,000 to 45. 30%, I'll come back to that one and I'll talk about this column in a minute. Then the 32.5% bracket, so from 37,000 to 90, they've changed that now to be from 45,000 to 120,000. The 37 bracket, 90 to 180, has now changed 120 to 180, and then the 45% tax bracket has not changed. They've also given what's called the low income tax offset. They've increased that as well. So if your income's up to a certain threshold, they actually reduce your tax even further by giving you a rebate on your income. And that threshold is around the $40,000 mark, $40,000 to $50,000 mark. I don't have the exact number now, but that's what's available too. The key one, just out of interest, is to look at what they're proposing from 1 July 2024. And the key one in that one is this new bracket they're providing, if it goes ahead. And you'll see it's a really large bracket where they're basically eliminating these two brackets here, 32.5% and 37%, and coming up with one standard bracket of 30%. So once your income is over 45 and between 45 and 200,000, you'll pay 30% tax on your income. And then, as I said, the next two brackets are removed, and then you'll pay 45% tax on your income above 200,000. Now, plus Medicare. So you've got to add Medicare levy to it. So 2% Medicare levy. But that's what they're proposing. So that's a substantial change, which is earmarked for 4 years' time. Now, governments change, circumstances change. So we'll see if that actually comes in. But key thing at the moment is this, what's available now. So you should be all seeing an increase in your take-home pay if you're getting a wage. The next one, the $4 billion job maker hiring credit. So this one is designed to encourage businesses to employ people aged between 16 and 35. And what they're actually providing from the 7th of October 2020, that they'll give you an amount of up to $10,400 per year if it's for an additional new position created. So it's not just a matter of terminating someone and then hiring a new person in that place and therefore getting this credit. You must be adding a new position to the business. So it must be an increase in your employees, not just replacing one with another. But it basically works out that if they're aged between 16 and 29, you get $200 per week as a credit from the government. And if they're between the ages of 30 and 35, you get $100 per week credit. Now, this one is not law yet. It has passed through a committee, which actually gave their recommendation for it to proceed today. They said there are some flaws in it because one of the things that they did note that it's age discriminatory because it's encouraging people, encouraging employers to hire people up to the age of 35, and there's nothing that's available for anyone over 35 in this respect. So, but having said that, they have recommended, this is a bipartisan committee, to still proceed with it as it's proposed. So we should see that coming into law fairly soon, and then they will backdate it to the 7th of October. So it's an important one and can be really relevant to you. One of the other criteria which I didn't list on here is that you must, that person who you employ must be currently on job seeker or new start allowance. So that's another factor that you need to take into consideration. Now, this is a really important one, and I think this is one that will have most relevance to people. So this is the immediate deduction for business investment in capital assets. So It allows businesses with a turnover up to $5 billion to claim a tax deduction for the full upfront cost of purchasing equipment or motor vehicles or whatever it might be. So there used to be a cap of 150,000 on the asset amount, and there used to be a cap on in terms of your turnover, but they've changed these rules, and this is one that's very significant. So, as an example, if you've got a situation where you need to buy some machinery for $300,000, then if you purchase it for your business and it's ready to be first used and installed by the 30th of June 2022, you'll be able to claim a tax deduction for $300,000. So that's quite a substantial thing. And I've just given that example where a new truck, similarly, that if you pay for a truck for $60,000, then you'll get a 100% tax deduction in the year in which you purchased it. Normally, you would then spread that over the life of the asset. So it might be 5, 6, 7, 10 years, depending on what the ATO deems to be the useful life of the asset, but they're actually allowing you now to write that off 100%. One important thing to note on this, which is a lot of people get confused about this, it's not $60,000 tax back. So if you're buying that truck for $60,000, it's not that you get a tax refund or a tax reduction of $60,000. You've got to apply your effective tax rate. So if you're a company and the company tax rate at the moment is 26%, then you'll save $15,600 in tax for that purchase of a $60,000 truck. So don't think, oh, look, I buy the $300,000 equipment, therefore I'm not going to I'm saving $300,000 in tax. That is not the case. It's what the effective tax rate is on that. And most likely, if you're a company, it'd be 26%. If you're a trust and then you distribute those profits down to beneficiaries who are on higher rates, and it might be a higher rate than that 26%. The other part of which they've allowed for on this too, because that's for new assets, and that's really critical to understand that's for new assets. That $5 billion turnover threshold applies to new assets. There's also it applies to secondhand assets. So if you buy a secondhand asset, so the secondhand car or secondhand truck or whatever it might be, if your turnover is under $50 million, then you will then similarly get that tax deduction 100% up front for that asset, even though it's secondhand. So that's again another good concession that they've allowed for. And then lastly, just because they want to make things complicated, if you are a small business with a turnover of less than $10 million, if you have pooled your assets, I'm not going to go into much detail, but if you're a small business, you're able to pool your assets into a depreciation pool and depreciate them under a flat rate. If you qualify under that pooling regime, then whatever the balance of that pool is at the end of this financial year, 2021 year, you're able to then write that off as well as a full tax deduction. So give you an example, you might be a business that's turnover is less than $10 million. You've got $350,000 worth of assets in your business that have got a written down value of $230,000 because you've been depreciating over the last 3 years. That $230,000, you'll be able to then write off at 30 June 2021 and claim a tax deduction for that whole $230,000 in this financial year, even though you purchased the equipment maybe 2 or 3 years ago. So that's a really important one if you meet that criteria of that $10 million turnover threshold. So provides a lot of tax benefits for small business. What the government wants you to do with that is to, one, invest in further assets if you can, but then secondly, using those tax benefits to then reinvest that money into your business to either employ new people or to buy other business assets within the business. So it's one of those things where it's important for businesses, if they are to take advantage of this, that what the government's hoping is you don't just put that money in your pocket, you actually then use that money and spend that money in the economy to try and stimulate the economy. That's the part I'm not fully convinced about, whether they'll be as effective in that respect, but that's what they're hoping people will do. The other danger with all these concessions too, or this one particularly, I think too, and this is my commentary only, is that that might make your business more efficient, which might mean you need less employees. So it might have a negative impact on employing people. The government has projected that this measure alone, they think, will provide for an additional 40,000 additional employees across the nation. I'm not sure about that one, but we'll wait and see. But really important and a really good benefit that businesses can get. This one, I'm not going to get into much detail because it's quite technical, but this one is called the loss carryback measures. And what this means is that if you have a situation where you might have paid tax in the 2019 financial year for your company, and then you made a loss in the 2021 financial year, then you can then claw back the tax that you paid in the 2019 year against the loss that you made in the 2020 year. So they're about doing a reverse engineering of the rules that currently stand at the moment, where if you incur a loss, you can carry that forward, then offset that against future income and future tax. They're reversing that for the next 3 years only, up until 30 June 2022, whereby if you make a profit in 1 year and you pay tax, you can then get a tax refund of that tax you've paid if you've made a loss in a subsequent year. And again, I'm not going to get into all the details of how it works because it's very technical, but very simply, if we had, and I'll do it on a 30% tax rate because I can work it out very easily in my head, but if we had a $50,000 profit in 2019, we paid tax at 30%, which is $15,000, and then we had a loss of $30,000 in the 2020 financial year, the tax benefit of that loss at 30% is $9,000. We can therefore claim $9,000 of that $15,000 tax paid in the previous year as a refund from the government. So that over the 2 years, we're averaging out the tax and only paying tax on the net profit over those 2 years. So that's another important one that's available. Again, there's lots of technical parts of it, which I'm not going to go into, including details about franking account balances, etc. But it's, again, something that's available to clients. And there'll be, I know that from our client base, there'll be a number of clients that will be eligible for this and will take advantage of it. Now, also they're extending some of the small business concessions available to bigger businesses. So they've increased, this is generally applied to businesses with a turnover of $10 million or less, but they're extending this now to businesses with a turnover of $50 million or less. And what they're allowing is a whole bunch of things which I've listed here. Probably a couple of the key ones that are really important is FBT exemption on portable electronic devices from the 1st of April 2021. Previously, prior to that date, when it comes into effect, you could only have one electronic device per year for an employee without it triggering FBT. They're now allowing you to have multiple devices because they understand that people might have their laptop plus their mobile phone, plus they might have a laptop at the office and also one at home or whatever the case may be. So they're actually reducing, giving you further exemptions regarding portable electronic devices. Similarly, they're also providing car parking exemptions from 1st of April 2021. So again, very quickly, if you had a large-scale car parking facility nearby and you're providing car parking benefits to your employees through that car park, you would pay FBT if it was above a certain amount per day. They're actually removing that exemption as well. So they're trying to cut through some red tape in this respect and make things easier for small businesses to basically run their business and get some tax benefits which they otherwise wouldn't. There's also a whole bunch of other ones in there as well, which I'm not going to go into, but that's what's available for businesses at the moment. Some honourable mentions, which is also important. Small business grants, so the Victorian business support grants that have been coming through. So we've had phase 1, phase 2 and phase 3. The Victorian government negotiated with the federal government and they are now tax-free. So you do not have to pay tax on any Victorian government grants that you receive from 1 July 2020. So anything you receive for July, August, September, October will be tax-free. The key thing is that that applies to Victorian businesses only at the moment, but other states may be applying for things similarly. But that's a specific grant, I suppose, a tax-free concession for Victorian businesses who've been claiming those business support grants. So really important one, that 10,000, 15,000, whatever it might be for your business, you don't have to pay tax on that, which is a good thing. They've also changed some corporate residency rules. Not that I think we need to go into too much detail on this, but basically if you're incorporated offshore but you've got a significant economic connection with Australia, they're now allowing you to be deemed to be an Australian taxpayer for tax purposes, and that opens up some benefits in terms of avoiding double taxation, etc., that may occur if you're still deemed to be a foreign resident. But that one I don't think will apply to too many people here, but relevant to some of the work that we do with our clients. So that's pretty much the main things. Now, obviously, there's infrastructure and other things which we covered briefly before. Look, not relevant from a tax point of view. So I'm just focusing on the tax benefits that are available. But certainly, the key thing with all these things is to get advice about them. So if you're not sure about how they work, because again, we can talk about the headline details in this presentation. About what you need to be aware of and what you can and can't get. But as I said at the start, it's general in nature, but there are certain elements to the rules that I haven't detailed here that may apply to you, that may either mean that you do qualify where you think you may not, or vice versa, you may not qualify where you think you do, because it comes down to the detail within the legislation to see whether things may or may not apply to you. And to give you an example on that, just back to the asset write-off one, if you have your assets in one entity and then you lease them to a related party, then there are restrictions on whether you can tap into all those different concessions that they're providing. So it's really important you get advice before you go ahead and buy that very expensive piece of machinery on the basis you think you're going to get that tax deduction, because it may be that you may not qualify. Secondly, I always say this, don't do things just for a tax deduction. It's got to make sound business sense to do it. Because remember, when you claim a tax deduction, as I highlighted with that example with the truck, where you only get $15,600 back of the $60,000 that you're spending, you don't get all your money back on that investment. It's only a portion of it being what your tax rate is. So don't do things just for a tax deduction, because the cash flow outcome for that is not positive. Only do it if it's a necessary business expense that you need to incur or will help you in growing your business or making your business become more efficient. Then that's the basis on which you should be doing it, not purely for the tax benefit. So yeah, that covers the main elements of the budget. Most of those things are passed through Parliament that we've covered off. The only one that hasn't at the moment is that job maker provision. But as I said, the expectation is that will be passed in the next couple of weeks, so that then all the things that we've covered off today will be covered, will be legislated. And last thing with all this too, all these wonderful things are great. You don't get the tax benefits until you lodge your tax return too. So we're talking about all these things that have, applying from 1 July 2020 or from budget night or whenever it may be, but you won't get the actual tax refund or the tax benefit until you lodge your 2021 tax return. Now, the due date for that will be after 30 June 2021. So again, you've got this lead time before you actually see the benefits of some of these incentives or these tax benefits. So you've got to bear that in mind too, in making sure you manage your cash flow effectively, so that you're not leaving yourself short because you're investing in assets now that puts a strain on your cash flow. These rules apply any time up until 30 June 2022, most of them. Secondly, it doesn't discriminate about when during the financial year you actually purchase that asset. Back to that asset purchase example, if you buy it on 30th of June, you'll still get the tax deduction, the full tax deduction. It doesn't matter that you only held the asset for 1 day or 1 hour. It comes down to the fact that it's in this current financial year. You'll then get the benefit this year. So again, just really important that you make sure you plan your cash flow to ensure that you've got the necessary cash flow to fund your business operations, particularly as we're coming out of COVID-19. And it's going to be a bumpy road for a while yet. It just makes that cash flow is really important. We'll cover that in the next part of the session that I'm about to present now. So that covers the tax matters. So if anyone's got any questions that they want to ask now, I'm more than happy for you to do so. Otherwise, we'll get on to the next part of the presentation. So this one I think is really important. It's about business planning and key metrics. So what we're going to talk about here is about the things you need to think about in your business and information that you can get from your accounting reports, etc., to basically make informed and good business decisions, and make sure you've got all the necessary background information you need for when you're trying to grow your business. So what we'll start off with is just talk about monitoring and planning. So the first part of it is, monitoring and planning. Business is not just about turning the lights on, opening the front door to customers, or opening the office and having customers come in. That's one part of it, which is really important because that generates the income, obviously. But then it's also about how you use the financial information and everything that comes from operating your business to make properly informed decisions going forward. So when you're running an enterprise, we as your accountants, we prepare financial reports for you, financial statements and tax returns. And they give you a picture of the business based on dollar terms, but it's more than just the dollar terms, and it's more than just a snapshot. So what we always say is it's really important that you prepare regularly your financial reports, and also so that it can assist with budgeting, cash flow, and also making business decisions into the future. And the more regularly you prepare your financial statements and review your financial statements, so whether that's on Xero or MYB or whatever, you're looking at monthly or quarterly, whatever it may be, as I said, the better you are able to make decisions because you're better informed and you're not trying to do things after the event, in effect. And that's one thing that's really, really important. It doesn't matter what type of business you are, whether it's a sole trader, partnership, trust, or company, having timely information available to you to make business decisions is critical. So as I said, if you're running an accounting software such as Xero or MYB, looking at your financial reporting, so getting your financial reporting done on a monthly basis as a minimum, I would think. Some people do quarterly, but I'd suggest minimum is monthly is what you really need to start doing. So you've got a good snapshot of your monthly reporting, and that's done fairly quickly after the end of each month, so that you know, within a week after the end of the month, you've got profit and loss balance sheets, you know what your cash position is, you know who owes you money, you know what money you owe to other people, you know what your GST potential liability is at the end of the quarter if you're reporting quarterly. All these different key business metrics. By doing monthly reporting on doing it regularly, so monthly or quarterly, whatever it may be, but I'm suggesting monthly, and then actually looking at those reports and interpreting those reports is critical for the success of your business. And I've found over my time as being an accountant that the businesses that do that and do that regularly are more successful than those that don't. So having a finger on the pulse with your business in a real time is really critical. So how do we do that? Well, there's a whole bunch of things. And what we'll look at first of all is the cycle of planning and monitoring. So, you know, most businesses when they start up, they do a business plan. And then, so question is, do you have a business plan and do you review it regularly? Or does it go in the top drawer or the bottom drawer somewhere and you can't find it after 10 years? So a really critical one that you've got a business plan and you review it and you monitor it and you adjust it as you need to based on changes in circumstances. And obviously, for instance, with COVID-19 coming about, that will be a good opportunity to review your business and the plans and recalibrate them. Look at different opportunities, etc. SWOT analysis, strengths, weaknesses, opportunities, threats, and try and develop strategies on how you can overcome the difficulties of COVID-19. Also look at preparing budgets if your business is, that's important to your business. So look at what you want to try and achieve in terms of your business for the year. So you've got some clear benchmarks that you, and KPIs and that you can be held accountable to. So setting a budget for profit, for turnover each month, looking at your expenses each month, etc. So looking at that annual financial budget, which will be cash flow, profit and loss, and also balance sheet. So really important. And then, as I said before, preparing monthly management accounts. So again, doesn't mean us as your accountant has to do that for you every month, but getting, you know, good quality financial reports done on a monthly basis, and then and the key thing is looking at those financial reports. And then obviously at year end, it comes to doing the financial reports and tax returns, which says, right, this is what the total tax liability will be, etc. And this is what we need to do. So it's really important that you look at each of those different cycles of planning and monitoring and make sure that you're ticking the box on all of those things in a timely manner, and not leaving it till months after the end of the month to do those quarterly reports or whatever it might be. Hopefully, because of GST and reporting for GST, quarterly means that most businesses are doing this on a quarterly basis anyway. But I'm suggesting that we probably need, particularly in this environment now, we probably need to bring that back to even monthly. So you've got a good handle on where your business is at any time, because things can change very rapidly, as we've seen over the last 6 to 12 months. So then analysing the financial statements. So it's then looking within those financial statements. So the key items are the profit and loss statement, the balance sheet, and the cash flow statement. We generally don't prepare a cash flow statement for our clients at year end, but again, when you look at your accounting software, a lot of the software has that built into it, that you can do cash flow statements to work out where your cash is coming in and where it's going out and what your net cash flow is on a monthly basis. And the key thing, which I'll show you later, is that cash flow doesn't equal profit and loss. So if you can have a situation where you're making a wonderful profit, but your cash flow is nowhere near the same as what your profit is. And I'll go through why that could be different. Then it's also important to look at who actually uses the financial statements. And, you know, you need to make sure they're prepared timely so that if you've got a potential investor, they can then access that information quickly. Lenders, so if you need to go and get finance because you're looking at buying a new piece of equipment to get this asset write-off, or sorry, I should say because your business needs it and then you're taking advantage of the asset write-off, then it's important to have timely information available for the bank, and they really want to see that. And they're now to the point where they're getting really strict on financial reporting. They generally ask for year-end financial reports to look at it, but they generally don't accept them if they're more than 3 to 6 months. So depending on which bank it is, it's generally 6 months old if they're more than 6 months old. So if you're not getting your financial reports done until year-end financial reports done by your accountant until say January or February, and then you want to get finance, then the bank may not accept those documents as being relevant. They'll then ask for interim financial reports to be done up to the end of December or whatever date it might be. Therefore, it's important that you've got the information within your system accurate and timely, so that then you can do those with little fuss and in a quick, on a timely basis. And additional suppliers and trade creditors and also tenderers. So there might be requirements where you're going for a tender, and one of the criteria of the tender is you need to provide your financial statement to show that you've got the solvency to be able to do the work. So it's really important at any time that you've got that information at hand. Now, obviously, us as your accountant, or if you don't act for us, we can assist with that. We do that with a lot of clients in helping with their monthly or quarterly reporting. But it's certainly something we can help you with and train you on to do on your own as well. So you can do a lot of the things that on a monthly basis that can also assist with getting that accurate information. So then it's also looking at the key business metrics. So when you get those financial reports done, it's looking at what's within those, which can tell a story for you and then drive your business decisions going forward. So what we talked about before, making sure they're done timely. Are they purely cash driven or are they tax driven? You know, obviously a lot of people just it's a necessary evil. You've got to get your financial reports and tax return done purely because you're required to lodge a tax return. But my argument against that is that financial reports and tax returns are not just for tax. They're to tell a story about your business for you to then use that to make informed decisions going forward. So having those done regularly means you can be nimble and adapt to change, and also then use those for as a getting finance or whatever the case may be. So really it's a matter of making sure that you're using those accounts in the right way and that they're good, accurate accounts. And again, you might see that us as your accountant does a lot of adjustments at year end if we're only doing the year end work for you. And therefore the monthly accounts may not mean much because we do so many adjustments at year end. And that's why, again, it's really important that we either educate you and train you to be able to do that monthly, or we get involved in that to help you do that on a monthly basis so that you've got accurate reports along the way during the year. So then what can you look at in terms of those key business metrics? So it's important to evaluate performance by comparing to a set standard. So that might be results from previous year's activities. So comparing, say, October 2020 to October 2019 to see how you're tracking, both on an income and expense level or cash flow. Looking at industry averages. So for instance, there's lots of benchmarks that are available out in the marketplace that we have access to. So you know, for instance, we can look at what average wages are for a cafe, what the average rent expense would be for a particular manufacturing business with this amount of turnover. There's lots of industry averages which you can benchmark yourself against. Similarly, benchmark against competitors. We can actually get data for competitors and benchmark against them. Also looking at absolute standards. So that might be where there's just a given that that there's this margin would apply to this particular industry. We know that for, I'm just trying to think of what might be an example, that when you're selling TVs, that there is a set margin that you'll get on that TV in general, and therefore, you know, looking at those absolute standards. Or it might be that when we're valuing a financial planning business, we know that the buyer of last resort valuation of business is 2.5 times recurring revenue. So we can then look at that absolute standard to work out how the business is performing. So things like that. But again, that's where you can tap into your accountant or your advisor, or use resources that might be available through your accounting software to then do those benchmarks and look at these particular trends that may be relevant to you. And I'll give you some examples here. So here's some examples of what I'm talking about. So I've got on the screen here a profitability trend. So this is a client which we've white labeled, so you can see what it might mean in this scenario. So you can see we've got 3 test periods here. We've got 2018, 19 and 2020 in the different colors. And you can see we're looking at here gross margin. So this is a trading business which carries trading stock, and we're looking at the margin. You can see that the client in 2018 had a margin of 43%. Went up to 45% in 2019 and has dropped slightly down to 44% in 2020. And then the operating profit, you can see the up and down. Now this one's a fairly good example of being fairly consistent. Operating profit is before interest and expense and other things that are non-business related. And then we've got net profit, and we can see the trends there. Then we can also see, which is for the last 2 years, revenue growth versus cost of goods sold growth. And this is really important. So you can see revenue growth, and then you can see cost of goods sold growth. So really positive in the 2019 year that revenue growth was up by 1.9%, and at the same time we're able to reduce our cost of goods sold by 2.4%. So the margin improved because of that. In the next year though, we had a revenue growth of 11%, which is great, but our cost of goods sold growth was greater than the revenue growth. So therefore there was a bit of bleeding or reduced margin that we generated in that financial year because the cost of goods sold growth is higher. So therefore that then says, okay, so what does that mean? What has happened during the year? And it might be, for instance, if you're a business where the manufacturing cost or the importing cost of steel might have increased, or the exchange rate might have changed, and you know the Australian dollar, because you're importing, has gone from one point to another. So it's about analysing what's caused that by breaking it down into these different components, and then analysing and then trying to work out strategies on how we can mitigate that going forward. So there are a couple of examples. Some ratios, just bear with me, I'll just have a sip of water. And this just follows on from those graphs that we showed. So revenue, so we can see in dollar terms what the revenue has done from one year to the next. You see that it's increased, and the revenue growth is then also reflected in a percentage. And then we'll see our gross margin, which is our revenue minus our cost of goods sold. You see again, back to what we saw on the previous page, what it looks like in percentage basis. Then we look at our overheads, and our overheads for the 2019 year were 28.71% of our turnover. In the 2020 year, it's gone up to 30%. So it's gone backwards 1.39%. So again, why has that happened? And then we can look at the data within your financial report to then track that. We can do that on a monthly basis if we're preparing accurate monthly reports. We can look at it quarterly, 6 monthly, or whatever circumstance suits our purpose. But again, it gives you more information. Now, with this reporting that we're doing here, that's coming straight from the financial. We've got a software tool that we use for this, but it's coming from the data that's in your Xero file or your MYB file. And we're able to get these reports, which can give us a bit more story about what's going on with the business, as opposed to looking at what the bottom line is and how much tax I have to pay. It's more than that. And this can help you in terms of improving your business. And then you can see that the operating profit has actually dropped from 205,000 down to 197. So it's dropped from 16% down to 14%. So again, just gives you examples of what we can look at. Then we go even further and we look at working capital ratio. So this is focusing on things in the balance sheet now. So we can see in this situation that our accounts receivable day, so this is our debtor day. So we've invoiced the client, and in 2019, it took us 42 days to get paid from our client on average based on the turnover. In 2020, that has blown out to 54 days. So it's deteriorated by 12 days. And so that again leads to a question, what has caused that and what can we do to try and mitigate that? Because that'll have a direct impact on cash flow, which I'll show you later. Inventory days. So again, this company carries stock. Now, 95 days worth of inventory is what they held on average in 2019, and that's blown out to 108 days. So that means that it's taking them over 3 months from the date they purchase the stock for it to go out the door as a sale. So again, that's blown out by 13 days. Again, working capital, what does that mean for cash flow? It may not have an impact on profitability, but it will have an impact on cash flow. Accounts payable days, it stayed at roughly about 77 days for both times. Now again, that's that's generous. Will there be pressure on suppliers to say, look, we really need you to start paying us earlier? So again, if that came down by a fair way, then that might be that because suppliers are putting pressure on you, you need to fund those earlier. So that has an impact on cash flow. Sorry, that's dogs in the background, I apologise. Then the next one is working capital days. So what that is, that's a sum of the above. So it's that plus that minus that. So that's your accounts receivable, your inventory days, plus your working capital day. Accounts payable, less your accounts payable, means 60 days. That's how many days of working capital you need in this business based on your turnover. So that's a correlation to your turnover. So we need 60 days. In 2019, we needed 60 days worth of working capital to fund the business based on turnover. So that in effect is 2/12 of our turnover. So 2 months worth of turnover is what we need to fund the business. But that's blown out in the 2020 year to 84 days. So 24 days extra. And that means you need more working capital in the business. And that's what the number quantifies as. So we've got 173,000 is what's locked up in the business in terms of working capital for 2019. That's deteriorated by 89,000 to 263,000 in 2020. So again, what has caused that? And for every $100 worth of turnover, what working capital do we need? And what we're saying in this respect is for every $100 worth of turnover, we need $14 worth of working capital in 2019, but that's blown out to 19 days worth of working capital in 2020. So if we kept going as we were in 2020 and we want to grow our business, then for every dollar of sale, we need additional working capital of $20, 20 cents, or on every $100, we need $20 worth of additional capital that we need to be able to grow the business. And where does that come from? Does that come from the bank? If it does, then there's going to be a cost of finance of that, which is going to incur another expense. Does it come from the owners, where they have to put in money in from their own pocket? Perhaps. And that then means that the owners are putting more money in, which means that they're exposing more of their hard-earned money to business risk. Or does it come through reinvesting the profits that you've got within the business and not taking as much money out of the business as a dividend from the directors, so from the shareholders. So there's all those things you need to factor in. And it's really important that you understand these different scenarios. I'm not going to go into the others too much because we'll be here all night, but they're really important things to look at. So yeah, so what areas should you just analyse? So we covered off on those things just then, but we should look at sales. So compare them to budget and assess how did you go? Did you meet the budget expectations? If not, why not? What strategies can we put in place to try and improve to meet our budgets? Or are our budgets unrealistic and we need to recalibrate them and then recalibrate what we think we can generally achieve for the next 12 months? Look at your pricing. Now, it's easy to say, look, increase your price, increase your profit. It's not as easy as that because there's obviously business risk, and if you price yourself too far out of the market, then you may lose customers. Secondly, in this climate, it's probably very difficult where it's we've got actually negative inflation at the moment of increasing your prices. So it's being very understanding of that, but also being aware that there might be some situations where you can increase your prices. Actually understanding the customer base that you've got. How many customers do you actually have? What's the average spend per customer? Do you know that information? Therefore, you can then tailor your marketing strategies and your business strategies around those types of customers, or focusing on those that give you a higher return on per sale. So is it easier? So looking at the value of the transactions, what is the average value of the transactions? And maybe focusing your marketing efforts on those clients where you're getting a higher value per transaction. As I said before, if your cost of goods sold have gone up, if you don't push your prices up or you don't become more efficient in other ways, that's going to have an impact on your profitability and your cash flow as well. So if you're experiencing cost increases, can you pass those on to customers, or do you need to analyse those and work out whether you can get better buying somewhere else? Look at alternatives to suppliers that you may have. With the expenses, did you incur anything that's unusual? And again, have they increased higher than what is expected? So has your insurance gone from here up to here for this year? And is that a product of because you've had a claim on insurance or something like that, or whatever the case may be? But looking at the expenses and not just looking at the headline total expenses or the net profit, looking at individual expenses, and then maybe tracking those month by month to see if there's any trend in those as well. And then how profitable a business is obviously is important, and obviously cash flow as well. And I said to you before, profit doesn't equal cash flow, and I'll show you that in a minute. So this is one I really love, and I think it's really good to show and show the impact. This is called the power of one. Now, what this is, this shows you, based on this client that we've got as the example here, what different changes in metrics would have as an impact on the business cash flow wise and also profitability. So what we've got here is a 1% increase in price, volume, cost of goods sold reduction of 1%, overhead reduction of 1%. If we reduced our accounts receivable by 1 day, if we reduced our inventory days by 1 day, if we increased our accounts payable 1 day, and what the effect of that would be on profit and cash flow. And I'll just quickly go through those. So first of all, with price increase. So if we're able to get away, I shouldn't say that, but if we're able to increase our price by 1% to our customers, in this client scenario, the impact on cash flow will be $11,525, and it would increase the profit for the business by $13,526. Similarly, if we thought, no, look, we can't increase price, we're going to go for a volume-based increase, so we're going to try and increase our volume. If we increased our volume by 1%, what impact would that have on the business? And in this scenario, improve cash flow by $3,400 and impact profit of $6,000. Now, the key thing I want to highlight between these two components is you can clearly see that a price increase of 1% has a far bigger impact than a volume increase of the same amount. And this is why you've got to be very careful. And again, I'll come back to this in terms of the cash flow later on. You're also going to be careful about when it's volume increase, what impact that has on your working capital requirements as well to increase that volume. But clearly in this scenario with this particular client, cash flow wise, an increase in price has a 3-time multiple effect than what it does a volume increase. And from a profitability point of view, it has over 2 times multiple impact on the business performance than what a volume increase does. So our comment to our clients always is, you want to try and focus, if you're in a business like this one, we run this metric, you want to focus on price increase if you can. Now, if that's not possible, then you focus on cost of goods sold reduction or overhead reduction, because you can see in this scenario, all three of price increase, cost of goods sold reduction, or overhead reduction has a bigger impact on cash flow than it does to volume increase. The only one that doesn't have a better impact on profit is overheads in this scenario, versus volume increase. So you should be focusing on the things that give you the best return on your investment. Now, obviously, you've got to then take into consideration, if I increase my price by 1%, maybe that might have an effect of reducing my volume by 1% or by 2%. And the good thing about this modelling that we've got with this Power of One thing is that we can actually do variables of each. So we can actually say, right, if we increase the price by 1% and we reduce our volume by 2% because that's what we anticipate the impact on our business. What will the impact of those two scenarios be? And we can see if I was to do that in this scenario, sorry, I should have given this as a part of the presentation, but if a volume increases the profit by $6,000, if we did the flip where we did a volume decrease, it'd have the same impact by 1% as well. So if we reduce the volume by 2%, that would reduce the profitability of the business by $12,000 under the volume decrease, but we still have a price increase of $13,000, so we still may be better off by doing a reduction in volume and a price increase. Similarly, that might have some positive impacts on cash flow too, because we might have less working capital in terms of carrying stock. So we might be able to reduce our cost of goods sold as well because we're carrying less stock. And it might also mean that we have less overheads because we're not having to carry the same amount of insurance because it might be based on turnover or whatever the case may be. So there's all these different things that you need to take into consideration. And then we go down to the other one. So these are purely on a cash flow basis. So if we were to improve our accounts receivable days by 1 day, that's going to increase our cash flow by $3,700. So let's take that in the context. Let's say we can reduce our debtor days by 10 days by putting strategies in place. For this business, that'll have an impact of $37,000 on their cash flow. So again, it shows you what things you can concentrate on in your business and focus on to try and improve the business metrics of your business. It may not have an impact on profit, but cash flow is equally as important because cash flow obviously pays the bills and makes sure that the business has got sufficient cash flow to be able to operate effectively. And similarly with the inventory days and accounts receivable days. So you can just see how the impact of each of those things are on cash flow and also profitability. So this is a really good tool, and it's something that you can easily implement into your business to actually work out the key metrics and how these things have an impact on your business. And we've done this with some clients and we've seen some substantial impacts. And even where the point where we can increase our price by 5% and decrease our volume. I had one client many years ago who was in the chemical business, and they're working on margins of gross profit margins around 10%. And we actually modeled and we implemented a volume decrease of 50%, and their profit went up by 50% because they were able to retire a substantial amount of debt that they were using bank funding for their carrying their stock, which meant they saved an enormous amount of interest. They were able to increase some prices on some of their products. They also removed some of their slow moving and also low margin products that were below 10% out of their offering. So we actually were able to go through and actually highlight those different areas of the business which were not performing, and we're able to carve them out to then focus on those best performing parts of the business. And by reducing their turnover by 50%, they actually increased their profit by 50%. And that's because they were on a low margin based business and they were trying to make profits through the volume, and it wasn't working. So it's really important document to look at and really tool to implement, I should say, to give you better perspective on your business. And just quickly on that, so this just shows you for this business again. So if you would increase your revenue by $100, that's a cost of goods sold. That's your gross margin, less your overheads, leaves you with a profit of $14. So that means and then what we then look at is we look at what our investment is in accounts receivable, inventory, accounts payable. So it says we require working capital of $19. The problem we've got is that we've got, in addition to the operating profit, the cash flow from that, also we've got interest paid, tax paid, and then dividends that we want to pay out to the directors. So it means every dollar of turnover, based on what was historical data for 2020, every $100 of turnover, there was only $2.13 less left to reinvest in the business. So then we've got a situation where we need working capital to grow the business at $19.45. We've only got $2.13 plus some capacity to borrow, which is a calculation. It means we're short $16.87 per $100 of increased turnover. So where's that money coming from? So really important to know that if you're on a growth strategy, you've got to make sure you've got the cash flow to be able to sustain that cash flow. So in order to get this to the point where we get this back to zero, we need to really work on all the metrics. So we need to work on our accounts receivable to try and get those down. We need to work on our inventory to try and get that stock levels down. And this is what we did with that client I was talking about in the chemical industry, where we focused on these things, reduce the turnover to basically close this gap so they weren't having a shortfall. Because that client, every time they try to grow in sales, they would have to go back to the bank and ask for more money. And they came to a point where the bank wouldn't give them any more. And it was just a risky proposition because they had so much bank debt that based on their turnover, that the business was very risky based on its margin and everything else. And so we had a strategy that we implemented to do the things I talked about to get that shortfall back down to a positive figure. So then it wasn't a shortfall, it was as close to zero as possible. Budgeting, I talked about this before very briefly. Really important that you look at budgeting. So, you look at 30 June 2020, you'd say, right, what are we going to do for the next 12 months? Now, that doesn't have to be a financial year basis. It can be a 12-month period from today, or it can be a rolling thing, and that's what I suggest anyway. You do a rolling budget. So every month it drops off for the 12 months, you add another month, or you go out to 15 months or whatever it might be. But having a budget and a plan about what you want to achieve gives you accountability and drives you to try and achieve those results as well. So again, your software will provide details, provide you the ability to put budgets in there and compare actual versus budgets, so you can get some better information for your business. And again, you might say, look, we've allowed for this much of employee training for the year. And let's say it's $30,000 as an example. And we've spent maybe $25,000 of that in the first 4 months of the year. So therefore we know we've only got a budget of $5,000 for the rest of the year. So therefore we need to look at whether, one, we need to recalibrate that budget, or two, whether we need to start trying to manage the rest of the budget and spread it over the remaining 8 months of the year, so we're not going to exceed the budget. So it's looking at tracking actual month by month budget, but then also looking at year to date budget to what you're projecting for the whole year, to then again adjust the business based on how you're tracking against that budget. So really important. And you can create it for a number of different areas within the business. So if you've got different divisions within the business, you can certainly do it on a division basis, and you can also have that global budget. But it's something that I really encourage people to look at. And again, we can assist you with that. And again, your software can also provide details. So Xero, as an example, and MYB both have budgeting tools within their software that you can use and implement if you wanted to. And we can certainly give you assistance on that. But really important tool as well. Cash flow, critical. So as I said before, profit doesn't necessarily always equate to cash flow. So it's really making sure you know what your cash flow requirements are for the year. So, having a look at your cash flow statement for your business, and again, financial reporting packages such as MYB and Xero and whatever else it might be actually has this built into them, where you can actually get a good idea about what your cash flow is, and also it can give you ideas about what your cash flow looks like for the next 30 days, 60 days, 90 days. So you've got some good planning tools there. But really important, and as I said, really critical that you know your cash flow requirements so that you can then project out and then see if there's going to be a shortfall in cash flow at any time in the future, so that you can then prepare for that early. So if you need to go to the bank and get additional money and your business has got the metrics which allows you to do that, you're not leaving it to the last minute when the money's run out, because at the moment with banks, it's taking up to 6 months to get finance because of COVID-19 and the requirements they require to go through. So knowing sooner rather than later about your funding requirements is really critical. Similarly, it might be that, personally, you might have to put some money in 6 months' time. Having to know about it now versus, at the death knell, a week before you got to pay the next lot of wages, it's really important that you know that cash flow. So doing a cash flow projection is really critical as well, and really suggest you do it and you update it and you recalibrate it as things change as well. So again, really important part of the business. So here's just a quick example of profit versus cash flow. So on the left-hand side, you'll see profit, and then on the right-hand side, you'll see cash flow. So first line, we've got revenue. So the client did $1.352 million worth of turnover in 2020. That's what they showed on their profit and loss. That's what they invoiced to customers. But what they actually received from customers was actually $59,000 less than that, because they received from customers only $1.292 million. Similarly, on the cost of goods sold, they incurred expenses in the profit and loss of $747,000. But they paid out $777,000 to customers. So that's a negative cash flow impact of $29,000. So you'll see that gross margin from a profit and loss point of view was $604,000, but gross cash profit was only $515,000. So there's a negative $89,000 difference there. So even though your profit margin looks good, your cash is not so good. Then we keep going. We look at the overhead expenses. Now they don't change between the two in this scenario. So you look at the operating cash profit was $213,000. That's from an accounting point of view, but actual operating cash flow was only 123,000, which is that 89,000 variance again. And then we go even further and we look at other things. So we had interest paid, which had to come out of the business and come out of the cash flow. We had tax paid, which had to come out of the business and out of the cash flow. We had dividends that had to come out of the business, that's what we paid in the last year, 100,000 worth of dividends. And then we had non-cash items such as depreciation and amortization. But we did have a fixed asset, so we bought an asset which doesn't get reflected as an expense in the books fully because we're depreciating it of 25,000. So there's a variance there. So you can see overall, and then in addition, the client then actually put their own money back into the business of 73,000. So even after all that, you can see that the retained profit for the year was 28,000, where the cash flow was minus $4,915. And that's with the client putting their own money of 73,000 back into the business. So that dividend they took of 100,000, they had to reinvest 73,000 back into the business for the business to break pretty much even from a cash flow point of view. So you can see quite clearly here about the fact that profit is different to cash flow. And even though on paper it looks like they've taken 100,000 out of the business, because they've had to lend back pretty much 75% of that, from a cash flow point of view, the business is not performing that well. So it's actually had negative cash flow for the year if they hadn't put that money back in, and it would have been to the tune of around minus 70,000. So again, it highlights the fact that it's really important to not just look at your profit and loss metrics, but it's also really important to look at your cash flow metrics as well. Lastly, and this is the last slide that I'll cover for the day, it's also looking at business improvement. So what things can you do, which is not just looking at debtors, creditors, etc., but what are the tools you can actually use to try and improve on these things? And things could be, now's a great time, it's always a good time to do it, but any time to look at your systems and procedures is really critical. Try and identify where the pain points are in your business and where the processes are that are inefficient. So for instance, collecting debtors. What is your debtors process at the moment? Can that be improved? Is there a better way to do it through systemization and automation? Can using cloud-based software that integrates with other applications help? And I've got some examples here. So if you're a retail business, you can use a product called Vend, which is a point of sale and inventory management system, and Xero to basically record all your customer transactions from the cash register right through the bank account and the GST reporting. And I'll give them some links for those if they're relevant to you. If you've got a number of staff and you need to do rostering, do you do that manually or do you have software tools that do it? And a great one that again integrates with Xero and MYB is a thing called Deputy, which can actually help you with rostering your team members and can save you hours in that respect. Chasing debtors, a good product out there called Chaser, app name for it, but that's a great debt collection tool where it sends reminders to clients on a regular basis, and you can automate that so that it sends them regularly to them. So for instance, you can schedule it to happen 1 or 2 days before the due date of the invoice to say, hi Joe, this is a friendly reminder that your invoice is due for payment tomorrow or for the day after. Here's a link to the invoice and here's a link to our payment gateway so you can pay that invoice straight away online. And then it can have automated process where it does a follow-up 7 days after, 14 days after, 21 days after, whatever the terms you decide. So a really good, effective way to try and manage your debt collection. And it gives you wonderful, I'll tell you honestly that we use this product ourselves. And it gives you a wonderful report each day before they send every week about what activities it's going to do for that week in terms of chasing up customers. So we can then get a handle on that before the emails go out to the clients. And then there's so many other tools you can use that are cost effective that can do away with manual processes. So it's really important to look at your business and look at what's out there in the marketplace that can be relatively cost effective as well, very cheap, that can actually help you with some of those things that you're spending hours and hours on. So again, we've got lots of experience in this area at Aintree Group in terms of these tools that are available for clients who are on Xero or MYB, or even if you're not on those products, but products that can stand alone, such as Deputy, but also integrate, that can actually really help you in terms of your business and trying to streamline the processes and save you time so you can then focus on business development with your business, focus on the things that are really important, customer nurturing, whatever it might be, and you have these other things that are taking your time away from these other things that you shouldn't be doing. So only doing the things that only you should do, and then delegating or automating those things that you can do, that someone else can do for you, or a software application can do for you. So that's really important that you look at those things as well. So with all the other things, it's also looking at that in the context of what we've got here as well. So trying to keep it to an hour, we've just gone slightly over. So I know I've probably gone through it really quickly, but hopefully that gives you a good insight about what is in the budget, and then also what you can do from a business perspective and utilising the financial reporting that your business can provide you to give you timely information and for you to make proper business, fully informed business decisions. So if anyone's got any questions, please go for it now. You can turn yourself off mute and ask them, or put your hand up. And yeah, if you've got any further questions after this, you want, oh yeah, go Zena. Yep.
I'm just trying to unmute myself. The Chaser, does that software, does that talk to Xero?
Yeah, it fully integrates with Xero. Yeah. Yeah, so we use Xero in our back end, and we use Chaser, and it's a great product. It costs us about $100 per month. It might be actually $125 per month, but depending on your size of your business, it might even be cheaper than that. But yeah, it's a great product, and we use it, and we find it very effective. And it's good. You can take notes within it as well to put your own notes in there to then talk to the client about it again later on if you need to. So it's got a full transparent record of your discussions as well, where you can put notes in. And we've also linked it to our payment gateway, whereby, the invoice will be sent out to the client with a reminder. They can click on that invoice, and then they can click pay now, and then they can pay it automatically over on the screen with their bank account details or their credit card. And we use a different product which links with that as well. But that's the joy of using cloud-based programs, is that they generally, the ones that are what we call open APIs, they allow a lot of different products to talk to each other and can get that full integration. So yeah, but I highly recommend that one. As I said, we use that one. We've used that for a long time, and I think it's a really good tool.
Thanks.
Yep. Any other questions?
We just have a message from Peter in the chat that just says thank you. So I'd say that means he doesn't have any questions, but no worries, Peter. Thanks for dropping by.
Yeah, and thank you for everyone making the time. And yeah, if that's oh, is there any more? I just saw a flash, but I'm not.
Yeah, no questions from Peter, no.
Okay, no, that's great. All right, well, if that's it, thank you very much, everyone. Go and enjoy the rest of the day and the nice warm weather. And yeah, any other queries, please, get in contact with me or anyone at Aintree Group after this in the next few days. The key thing is those budget ones. I think it's really important, particularly that asset write-off one, that will have a lot of application for people. So we'll make sure, obviously, when we do the year-end accounts 2021, that we'll be taking that into consideration. And then secondly, if you need any assistance with monthly reporting, we're also here to help in that respect too. So thank you, everyone, and yeah, enjoy the night.